Here is a number that should genuinely stop you in your tracks. The Magnificent Seven. Apple, Microsoft, Google, Amazon, Meta, Nvidia, and Tesla collectively up just over 1% for the entire year. 1%, while the S&P 500 is up 8%. While the AI build-out most investors are using these stocks to play has been one of the most powerful capital expenditure waves in modern history. So what is actually happening here? Where is the real money flowing? Because it is going somewhere. And the answer is hiding in three stocks that almost nobody in the retail investing community is paying attention to, while institutional money has been quietly piling in for months. Each one just delivered an earnings report that frankly made the Magnificent Seven's recent numbers look pedestrian, and each one is sitting on top of a contracted backlog so large it gives you years of forward visibility into the AI build-out itself. Today, I'm going to walk you through all three. Before we get into it, if you are getting value from this kind of analysis, the kind that goes past the headlines into where the smart money is actually positioned, hit that subscribe button right now and turn on notifications. This channel is built around exactly this kind of research, and the next video, the next setup, you do not want to miss. Hit subscribe and let us get into it. A quick note before we go further. Nothing in this video is financial advice. I am not your financial advisor. I am an investor sharing my own research and reasoning. Do your own due diligence, understand your own risk tolerance, and make the decisions that fit your situation. With that out of the way, let us get into it. I want to set the stage briefly, because if you do not understand what is happening underneath the surface of this market right now, none of the three stocks I'm about to walk you through will land the way they should. The Magnificent Seven has been up just over 1% on the year. The S&P 500 is up 8%. That gap tells you everything. Institutional money has been rotating out of the largest tech names and into specific corners of the AI supply chain where the actual physical build-out is happening. Part of this is positioning ahead of the SpaceX IPO, billions of dollars of capital being raised by selling down positions in Apple, Amazon, Alphabet, and Meta to participate in what could be the largest public offering in history. But the bigger story is that smart money has already figured out something most retail investors have not. The biggest opportunities in this cycle are no longer in the names sitting on the front page of CNBC. The chip makers like Nvidia and AMD already ran. The memory names like Micron already ran. Dell and Hewlett-Packard, which build the actual computers that go inside data centers, doubled in a matter of weeks. And then the institutional money started asking the next question, the obvious one. Where do those computers go? The answer is into data centers. And those data centers need to be physically built. They need to be connected to power. They need to be cooled. They need an upgraded electrical grid to feed them. That is where the next wave of opportunity lives. And that is exactly where these three companies operate. The first stock is Argan, ticker AGX. And this one is genuinely fascinating because it is one of the clearest examples I can give you of a company where the institutional money figured out the story a long time before retail caught on. Argan provides engineering, procurement, and construction services for power plants, specifically the large natural gas-fired power plants that are now being built across the United States to feed the data center build-out. When a hyperscaler like Microsoft, Meta, or Amazon decides to build a multi-billion-dollar AI data center campus, that campus needs reliable, dispatchable baseload power. Solar will not work. Data centers run 24 hours a day. Wind will not work either. Nuclear takes a decade or more to build. Natural gas is the bridge, and Argan is one of the most experienced builders of those plants in the entire country. And the numbers underneath this business are honestly extraordinary. Argan currently sits on a record project backlog of approximately $3 billion. Their most recent quarter included a $125 million data center specific project added to their industrial segment alone. They have approximately 6 gigawatts of power generating assets currently under contract. The company holds over $720 million in cash and investments with no debt, meaning they can self-fund expansion without diluting shareholders. Net profit margin has expanded from 8.2% to 13.1% on a trailing basis. Most recent quarterly earnings came in at $3.47 per share, and the stock has been delivering earnings beat after earnings beat across multiple quarters. The result is that AGX has rallied over 330% in the past 12 months, which sounds like the move is over, until you understand that the company is now sitting on a multi-year contracted backlog, with management openly saying record demand is being driven by rapid electrification, AI workloads, the replacement of aging power facilities, and years of underinvestment in U.S. power infrastructure. The stock recently pulled back roughly 15% from its highs, and that kind of consolidation in the middle of a structural growth cycle is generally where serious investors look to add, not run. The second stock is Mastech, ticker MTZ, and this is where the numbers start to genuinely jump off the page. Mastech is a roughly $30 billion infrastructure construction company that provides services across communications, clean energy, power delivery, and pipeline construction. They build the physical infrastructure, the transmission lines, the substations, the data center site work, the fiber networks that connects everything in the energy and data ecosystem. They are not a niche player. They are one of the largest pure-play infrastructure contractors in North America. And the most recent quarterly results from this company were, frankly, the kind of numbers most investors only see in pre-revenue speculative names. In their Q1 2026 report, Mastech delivered adjusted earnings per share of $1.39, beating the consensus estimate of 98 cents by nearly 42%. That is not a small beat. That is a complete demolition of expectations. And earnings per share was up 174% year over year. 174%. Revenue came in at $3.83 billion, up 34.5%. Adjusted EBITDA jumped 73.3% year over year. The company raised its full year 2026 guidance to $17.5 billion in revenue on the back of these results. And then there is the backlog, the figure that gives this entire thesis its multi-year staying power. Mastech is now sitting on a record 18-month backlog of $20.3 billion, with a book-to-bill ratio above 1.4 times in their core power delivery and clean energy segments. Book-to-bill above 1 means they are signing new contracts faster than they are burning through old ones. The backlog is growing. Management used specific language on the call I want you to hear. They described data center connectivity and grid upgrades as multi-year, high-visibility growth drivers. Customers are increasingly signing alliance agreements and sole-sourced contracts because they trust Mastech to execute. This is what dominance looks like in an infrastructure cycle. And the stock recently pulled back roughly 11% over the past month, which is exactly the kind of entry window serious investors look for. The third stock is Quanta Services, ticker PWR, and this is the largest, most important, and in my view, most strategically positioned of the three. Quanta is roughly a $100 billion market cap company that provides infrastructure solutions for the electric and gas utility, power generation, communications, and pipeline industries. While Argon builds the power plants and Mastech builds the broader infrastructure, Quanta does something arguably even more critical. They expand the electrical grid itself. They build the transmission lines, the substations, and the grid modernization projects that make it possible for new data centers to actually receive the electricity they need to operate. And the numbers here are not just strong, they are the largest of the three, and they have multi-decade implications. Quanta delivered Q1 2026 revenue of $7.87 billion, up 26% year over year. Adjusted earnings per share came in at $2.68, beating the consensus estimate of $2.03 by nearly 32%. Adjusted EBITDA hit $686 million, beating consensus by 18%. The company raised its full year 2026 IPS guidance to $13.55 to $14.25, implying nearly 30% year-over-year earnings growth. Over the past 5 years, Quanta has reported positive earnings surprises in 18 out of 20 quarters. 18 out of 20. That is not a streak. That is a structural pattern of management consistently exceeding what Wall Street thinks is possible. And then there is the backlog, which is the single most important number in this entire video. Quanta is now sitting on a record total backlog of $48.5 billion with a 1.6 times book-to-bill ratio. $48.5 billion in signed contracted work. The CEO has been explicit that the largest contracted programs in this backlog have not even started flowing through to revenue yet, with significant project timing extending well past 2030. There is also a piece of this story that almost nobody is talking about. Quanta operates the only major domestic transformer manufacturing capability at scale in the United States. Transformers are critical grid infrastructure currently in severe global shortage, and Quanta controls the only domestic capacity at the level required to support the build-out. That is a moat, and the long-term piece is even more compelling. The U.S. electrical grid is genuinely ancient. It is vulnerable to natural disasters and cyber attacks. It needs to be upgraded just for AI, but for general economic growth, electrification of transportation, and grid resilience. Quanta does that work. They will be doing it for years. Let me bring this all together because I want you to see the picture these three companies create when you put them side by side. Three companies, one record backlog of approximately $3 billion at Argon, building the power plants. One record backlog of $20.3 billion at Mastech, building the infrastructure. One record backlog of $48.5 billion at Quanta, expanding the grid. Added up, that is nearly $72 billion in contracted, signed, multi-year work sitting across just three companies. Work directly tied to the same AI build-out that the Magnificent Seven has been struggling to translate into stock price gains this year. Each of these names just delivered earnings beats of double digits or better. Each has raised full-year guidance. Each has a book-to-bill ratio above 1, meaning the backlog is growing, not shrinking. Each has recently pulled back from highs, which is exactly the kind of consolidation that gives long-term investors a window. And each is sitting in front of a structural build-out that management at all three companies has openly described as a 3 to 5 year minimum runway, with implications extending past 2030. Now, I want to be honest about the risks, because no story is complete without them. These stocks are not cheap on traditional valuation metrics. Quanta in particular trades at a premium forward multiple that reflects high expectations. Any project timing slippage or major customer cancellation could pressure these names hard. Backlog is not revenue. It still has to be executed on time, on budget. The construction business is famously lumpy, and quarter-to-quarter results can swing meaningfully. These are real risks, not theoretical ones. But within that frame, what you have here is something genuinely uncommon. Three companies, all sitting on top of a wave that the largest hyperscalers on Earth are funding with hundreds of billions of dollars of capital expenditure every single year. The Magnificent Seven is up 1% on the year. These three companies have been quietly delivering the kind of growth most retail investors think they need to find in some speculative microcap to capture. They do not. The opportunity is sitting right here in plain sight with verifiable numbers and signed contracts behind every claim. The investors paying attention now are the ones the rest of the market will catch up to in a year or two. The investors who wait until the headlines catch up will be the ones writing the comments asking why they did not hear about these names sooner. If you want to keep getting research like this on the stories Wall Street is taking seriously, while retail investors are still chasing yesterday's headlines, hit that subscribe button right now and turn on notifications so you do not miss a single video. And speaking of what is coming, there is one more layer to this AI build-out that almost nobody is connecting yet, and it could turn out to be the single most overlooked play in the entire cycle. That breakdown is coming in the next video. Subscribe, and I will see you there.